Welcome back to the Deep Dive. Today we're getting into a book that honestly might just shift how you look at risk and reward, not just in finance, but maybe, well, everywhere. It's The Dhandho Investor by Mohnish Pabrai. And our mission for you today is really to unpack this one core idea he talks about. Heads I win, tails I don't lose much. Sounds almost too simple, right? A bit like a coin flip you can't lose. But as we dig in, you'll see how powerful this mindset can be. It's really the foundation for a smarter way to approach opportunity.
Yeah, and what's really interesting is where that phrase even comes from. Dhandho, it's a Gujarati word. It means basically business or maybe wealth creation. And Pabrai makes it clear this isn't just some abstract theory. He actually points to the real-world success of the Indian business community, specifically the Patels, with their incredible track record in the U.S. motel industry. So right off the bat, we have this compelling example of how this philosophy has been used very successfully for generations. It's grounded in reality.
That's a great starting point. So, okay, let's really dive into that core idea. Heads I win, tails I don't lose much. It's catchy, definitely. But what does it really mean day to day when you're actually making a decision?
Well, Pabrai connects it to making what he calls asymmetric bets. Think about it like this. You're looking for situations where the potential gain, the upside, is just massively bigger than the potential loss, the downside. It's not about finding risk-free bets. Those don't really exist. It's about finding bets where the odds are stacked so heavily in your favor that, yeah, you might not win every single time, but the times you do win pay off big, and the times you don't, well, you don't lose much. It's sort of the golden ticket everyone's looking for in investing, right? Minimizing risk while maximizing reward. Pabrai just gives it a name and a framework.
Okay, minimizing the downside. I get why that's appealing. But how do you actually spot one of these asymmetric bets in the wild? Isn't it kind of easy to just, fool yourself into thinking a risky bet has limited downside?
That's the key question, isn't it? It really forces you to be disciplined. It takes rigorous analysis and honestly, often a pretty good understanding of crowd psychology. And this is exactly why that Patel motel story is so perfect. Think about it. These were often immigrants, right? Arriving with very little money. They weren't going out and buying the shiny new motels on the main drag. No, they were looking for the rundown places, the ones maybe being neglected that they could pick up for, bargain prices, really cheap.
Right, so they were finding value where others just saw problems. Classic value investing, almost, but applied to small business operations.
Exactly. And then their strategy for running them was incredibly frugal, lean. They weren't throwing money at huge renovations up front. Instead, it was often family members doing the work, cleaning, managing the desk, everything, very hands-on, keeping overheads incredibly low. So they took these neglected properties and turned them into cash flow machines, but without needing a ton of upfront capital. They bought cheap and operated lean.
Oh, okay, and that's where the heads I win, tails I don't lose much really clicks into place.
Yeah.
Because the initial investment was low, and the operating costs were managed by family labor if one motel didn't quite work out.
The loss was contained, relatively small. Their downside was really capped.
Right. But if it did succeed, and apparently a lot of them did.
The upside was huge, exponential even. It wasn't just about making a living. It was building real equity, buying more motels, creating significant wealth over time, all from that very low-risk starting point.
It's kind of brilliant in its simplicity, isn't it? What strikes you most about that model?
I think it's how they leveraged what they had. Hard work, strong community ties, and this knack for seeing value where others didn't. They weren't gambling on the future. They were making really calculated moves based on the here and now. And they clearly knew how to operate those motels. That was their circle of competence, as Pabrai would call it. It was all about discipline and smart execution, not wild speculation.
Okay, that sets the stage really well. But for us listening today, how do we take that core Dhandho idea, that heads I win mentality, and actually apply it to our investment choices? What are the actionable principles Pabrai lays out?
He breaks it down into a few key principles, and they all really reinforce that same core mindset. First up is focus on simple businesses. Seriously, this isn't about trying to be the smartest analyst out there. It's about knowing your limits. Pabrai basically says, look, if you can't explain clearly, maybe to a kid, how this business actually makes money, you're probably wading into complexity you don't need. That simplicity is actually an advantage.
Yeah, that makes sense. Stick to what you know, because if you don't truly get it, how can you possibly judge the risk, the downside?
Exactly right. And that flows naturally into the second one. Buy businesses in distress. You're looking for good companies that are just facing temporary problems, fixable problems. Often the market gets way too pessimistic, overreacts and pushes the price way down below what the company's actually worth long term. That creates those bargain opportunities for investors who are patient and can see past the current gloom. You're basically taking advantage of fear, but only when that fear seems irrational or overblown.
That definitely takes some guts, though, right? To buy when everyone else is selling and the headlines are bad. Cart instincts usually scream run away.
Oh, absolutely. It takes emotional control. And to help with that, you need the third principle. Invest in businesses with durable moats. A moat, that's the term Buffett popularized. It's basically a company's sustainable competitive advantage. It could be a strong brand, maybe a low-cost structure, network effects, proprietary tech, something that keeps competitors at bay. These moats protect the company's profits over the long haul. They provide a buffer, a shield, even when times get tough. It gives the business staying power.
I like that moat analogy. It's visual. It's not just about what the company does, but what it stops others from doing effectively. A barrier.
Precisely. Okay, now this next one, it pushes back against a lot of standard advice. Few bets, big bets, and infrequent bets. This really hammers home the need for patience. The idea is don't just sprinkle your money across dozens of okay ideas. Instead, wait. Be patient. Wait for those truly outstanding opportunities, the ones where you have really high conviction. And when you find one, bet meaningfully. It's about concentration in your best ideas, not just diversifying for the sake of it.
That's a hard one. The market always feels like it's moving, like you should be doing something. So disciplined inaction is actually a key part of Dhandho.
A huge part. Inaction, just waiting for the perfect pitch, it's like a superpower. But when you do decide to swing, you need protection. Which brings us to number 5, the margin of safety. This is absolutely fundamental. Think of it as like a buffer, an error cushion. You're buying something for significantly less than you estimate its true value to be. Why? Because your estimate might be wrong, or things might not pan out exactly as you expect. That discount, that margin of safety, protects your capital. It ensures that even if you're a bit off or something unexpected happens, you limit your potential loss. It's the bedrock of heads I win, tails I don't lose much.
Right. It's like building in room for error because you can't predict everything perfectly. Makes total sense.
Exactly. And very closely linked is the idea of low risk, high uncertainty. This is a subtle but really important distinction Pabrai makes. He says we need to separate risk, which he defines as the chance of permanent capital loss, from uncertainty, which is more about unpredictable short-term stuff, market fluctuations, noise. He argues that the best opportunities often show up in situations where there's high uncertainty. Things look confusing, maybe scary, but the actual underlying risk of losing your money permanently is quite low. That uncertainty scares other people away, creating the low price.
Okay, separating real danger from just fog, that sounds like it requires incredible emotional discipline. Again, probably one of the hardest parts to get right consistently.
It really is. We're kind of wired to react to uncertainty as if it's always a threat. And then finally, there's copying. Cloning. Pabrai is surprisingly open about this. He basically says, look, learn from the greats. Study what investors like Buffett have done successfully for decades and, well, copy their approach. Why try to reinvent everything and make all the classic mistakes yourself when you can stand on the shoulders of giants? It cuts down the learning curve and leverages proven wisdom.
Cloning success. Interesting. On one hand, yeah, why reinvent the wheel? Smart. But on the other, does that stop you from developing your own critical thinking? How do you balance following with, actually thinking for yourself?
Good question. It's about intelligent cloning, not just blindly mimicking trades. You adopt the successful frameworks, the principles like demanding a margin of safety, looking for moats. But you still have to apply those principles using your own brain to opportunities you understand within your circle of competence. You learn the process from the masters, but you apply it yourself. It's learning how they fish, not just buying the fish they caught yesterday.
Got it. That's a really powerful set of principles. So, okay, we have the Patel Motels as the grounding example. Where else do we see these Dhandho principles playing out? Any other big examples that make it click?
Oh, definitely. The Patel story is kind of the archetype, but think bigger picture. Consider someone like Lakshmi Mittal, the steel guy. His whole global empire was built largely by buying distressed steel mills during industry downturns. He'd scoop them up super cheap when everyone else was pessimistic, then apply his operational know-how to turn them around. That's textbook Dhandho, right? Buying in distress, understanding the business deeply, applying discipline. It's the Patel model, just scaled up massively.
And that connects directly back to the legends like Buffett and Graham we mentioned earlier.
Yeah.
Their entire careers were built on value investing, buying good businesses cheap, demanding that margin of safety, staying within their circle of competence. They were living Dhandho principles before the book title existed.
Absolutely. And the key takeaway for you listening isn't just about these famous examples, it's that you can apply this too. It really boils down to cultivating patience. Seriously, patience. The great opportunities, the true done who bets, they don't come along every day, maybe not even every month or year. You have to be ready to sit on your hands, sometimes for a long time. And then when that fat pitch arrives, be ready to swing meaningfully. It means deliberately tuning out the noise, the hot stock tips, the market fads, the fear of missing out, all that stuff. You need to stick to rational analysis, keep your emotions in check, and keep your whole approach simple and focused. It sounds easy, but it's hard work.
It does sound logical when you lay it out. Low risk, high reward. Find asymmetric bets. But in the heat of the moment, with markets jumping around and everyone talking about the next big thing, how do you really maintain that discipline? What's the biggest mental barrier, do you think?
That's probably it, isn't it? The human urge to just do something. Action bias. And the fear of missing out FOMO, it's incredibly powerful.
Yeah. It feels like maybe the Dhandho investor's biggest battle is against their own impatience, their own psychology.
I think that's exactly right. It's a constant fight against that urge for instant results or wanting the validation that comes from doing what everyone else is doing. The Dhandho path often means being quiet, looking where others aren't, and sometimes acting when others are panicking. It's often a lonely path.
So let's try and wrap this up. We've covered a lot from the Dhandho investor. The core ideas seem to be: look for those asymmetric bets, heads you win big, tails you don't lose much, stick to businesses you actually understand, your circle of competence. Look for companies protected by durable moats. Always, always demand a margin of safety, buy cheap, and then practice incredible patience and discipline. Oh, and don't be afraid to intelligently clone the strategies of proven winners. It's really about finding those low-risk situations that might look uncertain on the surface, where maybe other people's fear or lack of interest becomes your advantage.
Exactly. And I think the most profound takeaway from the book isn't some secret formula. It's that successful investing, Dhandho style, isn't necessarily about being a genius or predicting the future. It's much more about applying basic common sense, being prudent, being patient. It's about making disciplined, low-risk choices over and over again, protecting your capital first, and then letting the upside take care of itself over the long run. It's a marathon, not a sprint.
Which leads us perfectly to our final thought for you to chew on. Forget investing for a second. Where else in your life, your career, maybe big decisions, even small ones, could you apply this heads I win, tails I don't lose much principle? Where might hidden opportunities lie simply because a situation looks uncertain or messy and other people are avoiding it out of fear or maybe just inertia? Something to think about. Thank you so much for joining us for this deep dive into the Dhandho investor. We really hope exploring these ideas helps you think differently about risk and opportunity. We'll catch you next time.